Hello, and welcome to another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark. Today is March 13th. It is 1:52 p.m. Eastern Standard Time. And today, I want to talk a little bit, or at least get started talking a little bit about trading versus investing. I know for a lot of people new to financial markets, the exciting part is the trading. The more glamorous part, I guess, is the trading. But the investing side also is just as relevant. And I say that especially when it comes to goal setting. Trading is at best inconsistent and at worst you just spend your time frustrated losing money. But investing can add a little bit of stability to your portfolio and also put things into scale. So for instance, if your goals are longer term, your financial goals, then you can lean a little bit more into the trading side of it because you have time to recover. But having somewhere to put the money when you do have your profitable trading days is also important, because if not, you'll probably just end up putting it back into the market and just watching it go away just as quickly as you got it. And that's where your investing portfolio comes in. Again, depending on your time horizon, you pick your investments that meet your criteria, and you park your money there. And it's a great way to save, because typically financial assets tend to keep pace with inflation, and in some cases they tend to outpace inflation, depending on how excited your central bank is when it comes to monetary accommodation. So typically over time, financial assets do tend to benefit from inflation and inflationary cycles, which is a wonderful thing, because a lot of what's happening with governments around the world, but in particular the United States, in response to the coronavirus, COVID-19, in the long term is going to play out as very stimulative. In the short term, it's relief, it's support for people that need it. But big picture, a lot of money is being put into a lot of the economy, and eventually it turns into transactions. But that's a good thing, because that means people have jobs and they can pay their rent and their mortgages, and they can go on vacation and pay tuition and all the good stuff. And their taxes. Most importantly, they can pay their taxes. Yeah, definitely do not ignore the investing side of what you're doing. I know a lot of traders out there are just excited about, making money, making fast money, relatively fast money anyway, when trading. But, you really should consider the portfolio side of financial markets as a good way to capture and grow at a more reasonable pace some of the profits that you make when you're trading. And how you pick your stocks, in particular your equities, and how you manage them, again, that's kind of up to you. That's not necessarily what I do. It's not necessarily something that I focus a lot of effort and attention trying to understand on any specific level. But I do understand it is a very relevant part of life and times in the financial markets. And it's not that I ignore that part of it. That's not what I do. That's not what I specialize in. I have a partner that does specialize in the equities side, the portfolio, the accumulation, the research, finding value in equities, and I let my partner handle that part of the investment profile, and I stick to my specialty, which is the trading side of the investment profile. And everybody sticks to what they're good at. The world just works better that way. So yeah, investing versus trading, it's important. Take time to really understand how it works for what you're doing, and especially if you are planning on using financial markets to help you achieve goals in life. Definitely consider the role an investment portfolio will play in that process, I guess, because it's a great way to, like I said, capture and store some of that value that you create from your trading. Because if not, you're just gonna go find something else to try to trade, and yes, you stand a chance of making more money on that money, but you also stand a chance of losing that money. So just keeping things in perspective. Also, long-term planning and goal setting. So that's that. Now let's jump into the trade book. So this week was a week, right? The way that I trade, just to kind of put things in context, the way that I trade, I basically trade trends, and I exploit those trends across assets by looking at correlations between instruments. So when the market's trending, I seek out, all these different correlations and find these different assets in different markets and basically just ride a central wave. And it works beautifully. But at some point, the trend comes to an end. Right? It stops, it consolidates, sometimes it reverses. And that's where I have the most difficulty, because the strategy is not set up to work ideally when markets are consolidating. Past few weeks, markets have been trending. There have been strong correlations. Everything's been working smoothly. The latter 2/3 of last trading week was brutal. At one point, I want to say everything that I had bought that week was down. It's weird because I'm sitting there looking at it and I'm like, when am I ever wrong on every single thing? Like, there was nothing that I bought that week that was up. Like, nothing. I was wrong on every single decision. Like, that didn't make sense to me. But because I look at longer term charts for my targets, I don't necessarily get confirmation until well into whatever's happening is happening. So towards the end of the trading week, I started getting confirmation on my longer term charts that markets were consolidating, some were reversing, correlations were definitely readjusting, because I actually had to rearrange my layout based on that. But yeah, so for about a week now, last 3 to 4 trading sessions, or not even trading sessions, trading days, markets have been in some kind of flux. But as the week closed out, looking at my longer term charts, it just seems like there was a bit of a reversal. And also, previous weeks, I was looking at or using the 10-year treasury as my lead asset, and the other asset classes were basically following. So just the way the correlations worked out, 10-year treasury would move, other markets would respond. As part of the readjustment that took place over the last 3 or 4 trading days, it seemed like the dollar took over that lead asset position, and most of the other asset classes are falling in line. The 10-year treasury basically consolidated for a week between 132 and 133. while the other markets got in line with the dollar. And now it seems like gold is shifting out of that positive correlation that it had with the 10-year treasury. So we're starting to see a divergence in the price on those, both on the longer term charts and on short-term trading as well. So that was an interesting shakeout from that whole whatever the hell the market was doing over the last few weeks. But I mean, I guess it's just digesting a lot of the news that's coming out of Washington in terms of stimulus and government spending and all this other stuff. So, long story short, week was bad. I took losses on a lot of things, correlations broke down, trends broke down, everything broke down. It was just red on the screen. I was able to start pivoting towards the end of the week. So on the trade book right now, holding a lot less things, holding a position in gold, a position on the S&P, of course, position on oil, and a position on the dollar. No futures, just all options on equities. So I got a bunch of options on ETFs. Gold, for instance, up until last week was just falling out of the sky. And actually, it was falling out of the sky in tandem with the 10-year treasury. But over the past week, what we saw was the 10-year treasury consolidated, gold kept falling. Then at a certain point, the 10-year treasury started pulling back. Gold kept pulling back with it, and then the 10-year treasury resumed its fall, and gold did not. It just kept going higher. So that was that break in correlation in that relationship. So overall, reversed the direction on gold. So reversed from shorting gold to net long gold, and I'm taking up small positions initially because, again, the markets have not started trending yet, which is when I feel more comfortable applying more capital to the trade. Right now, relationships are still being established. Trends haven't, started, setting up yet. It's just more of shuffling around, getting ready to start moving. So, And then basically, as I slowly start seeing confirmation on the longer term charts and across asset classes based on correlations, then I can feel more comfortable committing more capital and leaning into the trade more. And then again with the S&P, old support level turned resistance, looking like it's turning back to support, which is the 3,900 level on the S&P 500. It's back above it. Towards the end of last week, I saw the S&P again approaching that 3,900 level, and the previous week when it got to that point, it reversed. So it basically used that level as resistance, and it got to at that point. I saw what it did the time before. I thought it was doing it again. I set up a short position. It kept going higher, broke through resistance, and now it's retested it a couple times. So it's looking like old resistance is new support. So with that in mind, took on took a loss, of course, on the short position on the S&P, and put on a long position call option out to the end of the quarter. Similarly with gold, call options out to the end of the quarter, because I feel, it's only a couple weeks left in March anyway, but I think, within that time, I should get confirmation one way or another on whether this is a consolidation to extend with the previous trend or if this is a reversal. But based on what I'm seeing on the shorter term charts, it looks like it's a reversal, so I've begun setting up initial positions. With the dollar hit resistance, turned around. So I've got some call options that expire on Friday, shorting the dollar, and then I've got another leg that expires. I think it expires a month out, so I've got a week and a month on the dollar, and then crude oil. Crude oil was doing very well, even when on the days when the rest of the positions on the books the trade book was down. There were certain times when crude oil was actually up. But looking at short-term charts on crude, and again, I have long position on crude oil. I think that once it's settled above 60, found strong support above 60. Next resistance level on crude oil is about 77, and I think that's where it's headed. So I've got a long position call option on oil, but going into the end of last session, it looked like it lost a lot of momentum. So I'm actually considering going into the first half of next week, looking to put on some kind of a hedge on my long oil position, simply because it's looking like it's losing a little bit of momentum to the upside. But that's everything in the trade book right now. Like I said, last week was kind of brutal. A lot of trades just blew up in my face, I guess. Had to take losses pretty much like across the board, and then had to basically go back to my charts and try to figure out, okay, what's happening while it was happening. And as a downside to using longer term time frames, the confirmations come in a lot slower, and in the meantime the trades are running and they're running against me at that. But again, trying to be systematic and going based on the rules that I've established for myself. I've got to wait for confirmation. Once I get confirmation, I can make my trading decisions from there. But like I said, the strategy works really well when markets are trending. When markets are trending, the confirmations line up. I can commit more capital. I can be more confident in the trades. I can basically take more risk because the odds are leaning in my favor. But once markets start consolidating, they get to their significant points, they start looking at extending or reversing. The strategy doesn't necessarily work that well. But there is a way to trade a consolidating or a sideways market. And it's basically just a range-bound market, so you establish highs and lows and sell at the highs and buy at the lows. Just trade the range. So if markets are consolidating, I've got a baseline position. Looking at, for instance, with oil starting going into next week's trading session, I'm looking to basically put on a hedge. It's losing momentum. It probably hit resistance on some time frame that I'm not currently looking at, and if it's gonna pull back, trade some kind of a range, I'll put the hedge on, take profits on the hedge once I get confirmation that it found a bottom and it looks like it can support itself moving higher. And eventually the longer term trend should prevail and it should break out higher. But in the interim, it could bounce around sideways, and that's fine too. I just need to use a different approach when trading that kind of a market versus, basically just smaller position sizes, because at some point the market is going to break out and you don't want to be over exposed and positioned against the overall trend. So trading range bound, just smaller positions, more trading, less, sitting and watching. And once you get your breakout, then you can confirm your trend and shift your approach to more positions and more risk management than anything else. Okay, so now let's look at the dashboard. And if you notice, the things that I have on the trade book are the same things that I track on the dashboard, because those are the things that I track. If I'm constantly watching these 5 things anyway, I feel more confident in predicting or forecasting their behavior because I follow their behavior. So looking at the dashboard, and I also had to, like I said, I had to reorganize the format on the dashboard, because I like to group asset classes together based on function. And to keep things simple as possible, I try to make it binary. So it's either risk or safety, buying or selling, liquidity or illiquidity. And I tend to group the asset classes based on how the price action is trading. So things that are basically trending together are grouped together. And, just that simple combination of just combining, just looking at things that have similar price patterns and looking at their correlations, can give you an idea of the sentiment behind the market. And like I said, previous weeks, gold and the 10-year treasury were trading almost in lockstep, and the dollar was actually trading like a risk asset, which is weird because you would have days where the dollar would be up and gold would be up and the dollar would be down, and so it was running counter to its typical relationship with commodities. Well, towards the end of the week, we saw that those relationships kind of reconfiguring, I guess. But still, looking at the dollar, the 10-year treasury, those are, once again, my safety assets. So dollar represents liquidity and the 10-year treasury represents safety. Grouped with the S&P, gold, and crude oil as my risk assets. The weekly trend on the safety assets, the dollar and the 10-year treasury, are pointing down. At the same time, the weekly trends on the S&P, gold, and crude oil are pointing up. More so the S&P and gold. Crude oil, it's more flat. Which again, that loss of momentum, not basically keeping up with the other risk assets as far as having that upward momentum, is one of the reasons why I am considering, and a strong reason why I'm considering, hedging my long oil position in the short term, simply because it doesn't look like it's keeping up with the other risk assets. What that typically tells me when risk assets are being bought and safety and liquidity are being sold is that's a risk on sentiment in market, or in the financial markets. And that does line up with the inflation narrative around fiscal and monetary stimulus, especially in the United States. In the short term, the indicators on the dollar, and short term meaning just 1 week's worth of data, the momentum on the dollar went positive towards the end of the trading session. So Friday morning, you got a little bit of buying in the dollar, but it fizzled out towards the end of the day. So the overall trend in the dollar over the last week is negative. But the momentum turned positive because of that buying you saw in the Friday session. That buying pressure on Friday also pushed it above the support or resistance indicators. So as of Friday, on the dollar, it has support on the price from both indicators, and its momentum went positive, but its overall trend is negative. So it's a mixed bag on the dollar. It's basically consolidating. It hasn't established a new trend. It's consolidating. I took the short position, again looking at a longer term chart, but I took a small position because on my short term charts, it still doesn't have a clear trending direction. 10-year Treasury, however, makes no mistakes about what it's doing. The momentum is negative and getting more negative. So the price is falling. The trend is negative, just turned negative, but it's negative. And it has resistance from both indicators. So the 10-year Treasury is in an outright short. Last week, gold was doing the same thing. Actually, not even last week. 2 weeks prior, a week prior, gold was doing the same thing. This week that just ended, not so much. The relationship broke. The S&P. So the S&P, the trend on the S&P is up. It's positive. Momentum went negative on Friday, but it looks like it bottomed. Resistance. The price is overlaying one of the support or resistance indicators, and the other indicator is suggesting resistance. So trend is up, but otherwise momentum is down. The S&P is consolidating. It's consolidating above a long-term support and resistance level, which would be that 3,900 level I mentioned. So that was my indicator to buy, to go long. Again, it's gotten to this point before. It couldn't hold it. It fell back below it. If the S&P can keep closing and progress higher above 3,900, then I have higher, longer-term targets. But the minute the S&P drops below that 3,900 level, I close out my long positions, because that means that the price is not holding as support, and it may fall through it and look for a lower level of support. So as of now, as of the last week, S&P is trending higher, but its momentum is negative, so it's consolidating basically sideways towards the end of the trading week. Gold had a busy week. It was up, then it was down, then it was up, then it was up some more. So the trend on gold, right, is positive, but it's getting less positive. That's usually not a good sign. The trend is slowing down. Momentum is negative, but it's barely negative, and it's been getting less negative. So the momentum is trending higher. It's negative, but trending higher. The trend is positive, but trending lower. It has clear support on one of the indicators and resistance on the other one. So gold at this point is in flux, but based on the longer term charts, I took a small long position out a couple weeks. We'll see how it builds. If I need to, I can hedge. If not, the loss is not that big. But if I do get confirmation, then I can commit more capital. I can lean in on the trade and try to manage the risk around the price trending in one direction. And then crude oil trend is positive, getting more positive, but momentum is negative, just turned negative, and looks like it's getting more negative. And one indicator, it's highlighting resistance, the other one support. So it's kind of doing the sideways thing, but on the fact that it's losing momentum and the trend is positive but barely, I think it warrants a hedge, or at least looking at hedging the position. And that's it. That's the trade book. So no, I'm sorry. That's the dashboard. So overall, with most markets in some kind of some kind of a flux, some kind of a consolidation, reversal, a staging pattern. There really isn't a clear sense of risk on or risk off from just looking at the dashboard. The only thing that has a clear sense of where it's going as of now is the 10-year treasury. And looking at the correlation shift with the dollar and gold, I think we can from here see more of a consolidation in the 10-year treasury while the dollar catches up, or the treasury can keep falling and the dollar just accelerates to catch up to it. Gold seems to be lining up with the dollar but correlating with the S&P, so we're looking at gold moving higher, the S&P drifting higher. So gold may have more momentum to push higher. The S&P looks like we can get just a bit of a drift higher in prices, and crude oil is definitely losing momentum. So that definitely warrants a closer look on a shorter term chart to see if there are some short term support levels that are being broken, and if so, I can start exploring my options for hedging the position. But it's a small position, so it's not it's not of like dire consequence. You definitely had to scale back after a week like last week, like from a share capital preservation standpoint. I had to scale back. All about trying to live to fight another day. So now we can talk about the forecast. So with the forecasting that I do, I like to look at longer term charts. Puts things in context. It helps with the target setting. And then from there I can zoom in and trade between the targets. But just, having the targets in mind, it helps because I can build my trades with a bias, knowing that the prices overall has a tendency to move in one direction or another. So that it helps, shift the odds in my favor a little bit. So, but same 5 instruments that I look at on the dashboard, the same ones that I fall back to in times of crisis. So, correlations be damned. All my cross asset plays when the markets are not, when the strategy isn't working, I tend to close out the cross asset plays and just revert back to the core, which is the dollar, the 10-year, S&P, gold, and crude oil. The dashboard. So, on the dollar recently got to a resistance level. Basically bumped its head and turned around. That reversal puts it back in line to trend with the 10-year treasury, and with the overall idea or the overall narrative that there's going to be all this government spending, it's going to be stimulative to the U.S. economy, it's going to create demand, and the U.S. economy consumes more stuff than it produces every year, so that means we have to import all this stuff. It's going to create demand in foreign countries, and they're going to see economic activity and growth and development and just this huge spillover effect. With that narrative taking hold and the expectation of asset prices increasing in line with inflation, and keeping in mind that along with the Federal Reserve committing to letting realized inflation, rise and stay above their target for some extended period, in addition to them, the ECB, the European Central Bank, also committed to letting realized inflation, rise and stay above their target for some period of time until they see fit, I guess. I mean, they put it more eloquently than that, but basically, you're basically looking at the world's number 1 and 2 reserve currencies. Their monetary policy setting committees are agreeing to letting realized inflation rise and stay above target. That's the type of environment that the global economy is shifting towards. So, in terms of inflation and inflation expectations, investor expectations will, over the medium term, shift higher because that's what central banks have been telling them for about 2 years now. And most importantly, when the Fed decided not to intervene in the bond sell-off, pushing U.S. rates higher, that also signals to the markets that the Fed is willing to let rates rise in anticipation or to compensate for higher realized inflation. They're willing to step out of the way and let the inflation happen because they cannot otherwise create it. For the last 10 plus years, right? The ECB has been below target. Of course, the Bank of Japan. Everybody has been below their inflation, target. But it's just been monetary policy trying to stimulate inflation this whole time. And the only thing we've been getting from that is asset price inflation. So quantitative easing, ultra accommodative interest rates. It's all just been funneling money into financial markets, pushing up stock markets, pushing up bond prices, keeping yields down. Across Europe, sovereign debt is yielding negative rates. Out to 5-10 years. It's ridiculous. But now, on top of decades of ultra accommodative monetary policy, now we have fiscal authorities stepping in and spending in this giant Keynesian experiment where the private sector and consumers step back because of the pandemic and the imposed restrictions, which basically just simulated a recession, and the government steps in true Keynesian sense and fills the gap with government spending. And because of the ultra accommodative monetary policy, they can just borrow and spend because yields are so low. If enough money is thrown at the problem, it will go away. And at some point, that money then turns around and makes its way, out into the real economy. And with the COVID vaccinations, making significant progress in most developed countries, and with the availability of simpler vaccines that don't require as much in the way of logistics and getting them around and keeping them to temperature, I think, the world is closer to, having the economy look like what it did before COVID, where, people are able to travel and do business and meet in person, and, we can use and provide services and just transact, consume, be people. And with that, I think we can expect inflation. We can expect some kind of inflationary cycle. I thought about it, and this is something that was part of an article that I was working on about globalization and the end of globalization as we know it. The idea is that the entire world, really, but developed economies in particular, have been in this disinflationary macro cycle since the mid to late 1980s. So about the time Paul Volcker stepped in and did his thing with interest rates. And then you see central banks around the world start having inflation targets and actively managing monetary policy to achieve those targets. The world has been in a disinflationary cycle. Now, that disinflationary cycle has also played out along the network of globalization. So being able to develop the technology to move people, goods, services, and especially money around the world, we developed a form of efficiency that brought down costs. Supply chains were broken up and spread out to the point where you only did what you were most efficient at. It's like Ricardian economics left to just do its own thing, right? Everybody just specializes in what they're good at, and then we trade, and it benefits the consumers. It benefits the most amount of people. You're creating the greatest benefit for the greatest amount of people. The problem, though, is that the United States, it's lost every lead or every advantage that it's had, but there's always been another one there to take its place, and just in time at that. So let's take it back to the Make America Great Again era, right? The era that's being referred to. We're talking about post-World War II America, where if you consider every other major participant in World War II had their infrastructure just, bombed out, destroyed. Their bridges, their railways, their factories, their power grids, everything just, destroyed from war. They had to rebuild that stuff. The United States did not. So we were able to manufacture and supply goods to the rest of the world because they just didn't have the capacity. They didn't have the capability. The United States developed an advantage and grew to be a superpower, one of the world's wealthiest nations from that initial advantage. But by the time we got to, let's call it the Vietnam War, you had Europe and Asia being able to manufacture and compete, and especially on price, because they were able to compete on quality. And once the price became, a competitive edge, they took the manufacturing business away from the United States. That went elsewhere. But we're talking about 1970s, 1980s, right? Late 70s, early 80s. That's the start of the service industry in the United States. You get that rotation from manufacturing to services. And that's built off of the network of the internet. So from the late 80s through the 90s, early 2000s, well, honestly, until the tech bubble, the United States led the world in technology. We exported technology. We went from manufacturing goods and exporting it to manufacturing technology, creating technology, licensing it, and exporting it to the rest of the world. But by the time we had the great financial crisis, the housing boom, once again, Europe and Asia were outpacing the United States in technological development. The Chinese they made a blunder when they announced to the world their China 2025 or what, that policy where they want to be the leader in tech innovation, because the United States basically saw that as an act of war. Like, you just became an adversary, because basically if you take away technology and technological innovation from the United States, what do we have to export? What do we have to specialize in that we can then sell to the rest of the world? So that puts the United States in a very vulnerable position. And from my perspective, it seems like the Chinese have the capability, and most importantly, they have the financial wherewithal to be able to do that. And that's because they've been investing in their education. They educate their kids, and especially in the early education, primary, secondary education. In the United States, you really don't get a good education until you get to college, if you get to college. Up until then, like you stand a better chance of not getting, the best of the best in terms of education until you get to college. And that's if you can get to college and if you can afford to go to a select school. But the one thing I will say, though, that no other country can do better than the United States is to be black, to be African American. Hip hop culture. For reference or for context, kids around the world take social cues, mannerisms, the overall culture of hip hop, which was born somewhere in New York. At no point do I see kids in New York, black kids, urban kids, the kids that are the curators, the kids that are the kids that inherited hip hop, rap culture. I don't see them taking cues, social cues from another culture in another country. That's only going to be a one-way flow. So the one thing that America still has, that it has a monopoly on, is hip-hop culture. Black people. It's a renewable resource, as long as the police don't kill all the black people. But it's a renewable resource. No other culture, no other country can export hip-hop culture to the United States. And it's $1 billion industry. But if America doesn't want to be known for exporting hip-hop, then we need to start educating our kids so that they can compete with the kids in, not singling out any country, but the Koreans and the Chinese and the Indians. And some European kids too, but, for the most part, Southeast Asia. We have to be able to compete. And if we can't compete, we can't just go to war with every country that we can't compete with. But with the long-term targets, from where the dollar is, it hit resistance. It looks like it's going lower. Target on the dollar, about 87.50. It's currently trading, or last traded at 91.66 on the dollar index. I'm looking for a drop down to about 87.50. Is it gonna go there immediately? No. It's more than likely gonna bounce around sideways before getting there. But in the medium term, that's where I'm expecting it to go. 10-year Treasury, the 132, let's call it 132 and a quarter. That level represented a long-term support resistance level that was broken. Last traded 10-year Treasury was trading at about 131, and let's call it 3/4. I'm looking at, from here, the next major support level takes the 10-year Treasury down to about 127. With that kind of a target in mind, I'll definitely be looking for a longer term play that I can take on the Treasury. Basically, sounds like a call option, buying something with a little time on it, and it has the room to run. And it's currently trending. And the S&P. So the S&P, it's been bouncing around past couple weeks, but once again, it's back above that 3,900 level, which is a long-term, at this point, long-term resistance level, because it's broken above it, but I have yet to get confirmation on a longer-term chart that this is support. So it's broken through, again, a long-term resistance level. Will it find support? Maybe it will this time, maybe it won't. Currently, I'm positioned in expectation that it finds support and extends higher. But if it doesn't, I can hedge. But in all honesty, if it breaks below the support level, I don't necessarily think it's worth hedging. I think it's probably better to realize the loss and find a trade going in the opposite direction, because then I'm looking for a lower level of support if it just can't hold support, which basically just means that it's maintaining its resistance status, that 3,900 level. So if the market can keep closing above it, extend higher, that's support. If it breaks back below it, I'm reversing, taking losses on my longs, and going short. On gold, its brief correlation with the 10-year treasury pulled it through a long-term support level, but its recent break from that correlation has brought it back above that support level. So as of now, the support level was breached, but it was not broken because the price is back above it. If it holds above it, that's fine. If it starts trading back below it, that's a sign that the price is more than likely broken the support, and I can now consider it resistance and start trading short from there. But because it's back above that support level, if I get confirmation here, I can lean into that long position. But if not, it's a small loss to take, or I can hedge. But more than likely, similar with the S&P, when I see the price breaking longer term support resistance, it's usually not worth it to just tie up your time and your money trying to hedge a position. You're more than likely looking at an overall reversal. So salvage what you can from the trade, realize whatever losses you have to, and just reposition for the new trade versus just trying to hold out to prove that you're right. It's okay to be wrong. Everyone's wrong. I'm wrong. It's all about how quickly can you accept it. Well, first you have to realize it. How quickly can you realize it, then accept it, and then do something about it. Because in the meantime, if you are wrong, you're losing money. So the quicker you can snap out of it, the better. And crude oil. Crude oil found support at 60. It's kind of stalled out, but it found support at 60. It broke through that. It was a resistance level. It broke through it, and it's looking like it's established support above 60. The next target for resistance on crude oil is about 77. So it has a little room to run, which is why I've established the long position. But based on my shorter term charts, looking at a loss of momentum, it's worth looking at hedging going into next week. But overall, because of price establishing support and resistance being far enough above that it has room to move higher, I'm convinced of the long oil trade. And then it lines up, its narrative lines up with the macro narrative as well, with the spending and the prices and the commodities and demand versus supply, and definitely with the shale producers and OPEC. But long story, inflationary forces pushing oil in particular higher, and that's simply because demand kicks in faster than supply may be able to, especially with the shale producers still recovering from the shenanigans that OPEC Plus pulled a year or so ago, which for a period pushed oil prices negative, futures prices. It's weird. So these are the long-term targets. And the overall narrative with looking at the forecast is investors are selling liquidity and safety in the dollar and the 10-year treasury, and they're buying risk assets in stocks, gold, and crude oil. And again, the financial assets, the stocks, the gold, the commodities, the crude oil, the gold, they tend to benefit from inflation. And if we are entering a long-term inflationary cycle, macro cycle, the last one lasted 30, almost 40 years. So if we're looking at a 40-year unwind, we're looking at higher inflation expectations, and investors investing with those new expectations out to 2060. Right? That sounds crazy when you say it out loud. But who would have forecasted, 40 years after 2021 of, falling inflation, falling interest rates, right? If you asked them back in 1982 or 1981, I don't think they would have ventured to guess this. So, and then of course with the dollar trending lower, you're seeing domestic investors selling their dollars to buy foreign currencies so that they can buy foreign assets. So that investment flows well out of the United States. Is part of why we can expect growth in a lot of foreign countries, emerging economies, foreign markets, simply because if inflation takes off in the United States, being that the United States is a developed economy, the inflation can only rise so fast and so far. Most importantly, the Federal Reserve will only let inflation rise so fast and so far. But in foreign markets, developing, emerging markets, you can see faster inflation rising to higher levels and more asset price appreciation. So, domestic investors will sell their dollars to buy foreign currencies to seek out those types of investment opportunities. Similarly, investors will sell their 10-year treasuries if they're expecting higher inflation. There's no need to lock in a fixed payment when each subsequent payment will have less and less purchasing power because of the inflation. So that's the selling of the liquidity and selling of the safety, and then just buying everything else. So gold, I think, is a typical play on inflation, monetary policy, inflation expectations. It's, similarly to the narrative in Bitcoin, it's finite. There's intrinsic value in gold, however. It also has industrial applications. Great track record. Great track record as a store of value. Nothing against Bitcoin, though. I definitely think it's worth trading because it's so volatile that, it's a trader's dream. The thing moves so far, so fast, like you go small, you set up your risk parameters, and you have at it. Like you'll know whether you're right or wrong in short order. Like it's not going to take you all day or all week to find out whether your trade is right or wrong. Like you'll know fairly quickly because of how volatile the thing is. And then stocks, again, similarly, more spending, more money, and still fairly accommodative monetary policy is supportive for higher stock prices. Gold is an inflation play, and crude oil is a play on economic activity. It's a bet that the global economy picks up a lot faster than expected, and so oil demand picks up a lot faster than expected, and the supply lags the demand. So that upward pressure on crude oil just I think represents the expectation that there is going to be a lag in supply when we see a sudden or unexpected pickup in demand for crude oil from the economic reopening and activity and expansion and all that good stuff. That's the overall narrative behind the forecast as well. And on that note, that covers everything I had to cover today. The macro narrative, again, I think is important simply because it puts context and it also helps with the conviction behind the targets. Because if the targets line up with the narrative or the narrative lines up with the targets, that's always good. But when things start mismatching, that's the first sign that there's a disconnect, there's change happening, and I may or may not be aware of all of the moving parts. So having a macro narrative that lines up with the long-term picture, that's always nice. And right now we have that. And with that, if you have any questions, comments, or concerns, you can reach out to me at contact@runthenumber's.biz. That's contact@RunTheNumbers.biz. Again, this is your neighborhood financial economist, Katie Mark, signing out. Remember, when in doubt, take profits.